Welcome to the Cardinal Commentary for the fixed income portfolios. There's no question 2023 had its ups and downs in the bond market. The spring and summer were especially weak due to interest rate hikes by the Bank of Canada. From late 2022 to last summer, the Bank of Canada raised its overnight rate 5 times to 5%. We believe it's just a matter of time until the central bank starts to cut rates. A recent StatsCan report showed wage growth of 6.2% in December and 5.7% on a year-over-year basis, so that could delay rate cuts until later in the year. When the bank indicated in November that it might be done raising rates, the bond market staged a roaring comeback. The bond index returned 8.3% in the fourth quarter and 7.7% for all of 2023. The inverted yield curve, which began in 2022, continued last year, as many lenders offer 2- and 3-year GICs at lower rates than 1-year versions. In nearly all cases, investors earn a higher return the longer their money is locked in. Inverted yield curves signal that interest rates are expected to fall in the not-too-distant future. Duration is a measure of a bond's interest rate risk. Generally, the higher the duration, the more its value will rise as interest rates fall. By lengthening the duration of our bond portfolio, the bond values will increase more in the coming months.
In our bond portfolio, we can get close to a 5% yield now, but the expectation is that as we have this rate cutting cycle and as the economy slows a bit, long-term bond rates are going to start coming down as well as short-term bond rates. And the tricky part, the elusive part of it to understand with that is if you've got a bunch of bonds that are trading at 5%, and the interest rate environment falls till, say, 3%, those 5% bonds actually become more valuable in addition to the coupon because you can't buy them in the future environment. And so you get the 5% plus you get a premium because those bonds become more desirable.
And why do we do all this? Because it works. And that's the Cardinal Commentary for the fixed income portfolios. Thanks for joining us.